Hi, this is part 2 of Chapter 17, Hybrid and Convertible Securities. And we're talking about continuing with the convertible securities. And last slide we left off on was straight bond value, which brings us to an example. So, Dunkin' Company, a southeastern discount store chain, has just sold a $1,000 par value 20-year convertible bond with a 12% coupon interest rate. The bond interest rate will be paid at the end of each year, and the principal will be repaid at the 20-year maturity. So a straight bond could have been sold at 14% because this is a convertible. It's selling less at 20% due to the conversion sweetener. Okay. So if we look at the payment for 20 years, the present value of that payment is $794. And on the 20th year, you get the $1,000 back, which has a par value, which has a present value of $72. So the straight bond value is $867.54. So the value is the minimum price which the convertible bond is expected to sell at. Generally, only in certain instances in which the stock market price is below the conversion price will the bond expect to be selling at this level. Okay, so recall that the conversion or stock value of a convertible security is the value of the convertible measured in terms of market price of the common stock which the security can be converted to. So there's a direct relationship to the value of the conversion vehicle and how much stock it can be converted for. So basically, we take the amount of stock that can be turned into times the share price, and we can figure out the market value of the convertible. So when the market price, the stock price of the common stock exceeds the conversion price, the conversion or stock value exceeds the par value. So that's how we figure out the value. So for Dunkin' Company, what we were talking about before, the conversion bond described that I just talked about is convertible at $50 per share. Each bond can be converted to 20 shares. So if you take the $1,000 divided by 50, it's 20 shares. So the conversion value of the bond, if the stock is selling between $30 and $80 per share, is on this table before us. So at $30, the stock price falls, the bond price will fall in comparison. So the conversion value is only $600. But if the stock price goes up to $80 per share, the bond will be worth $1,600 because of the conversion factor. Because I could sell 20 shares at $80, which is $1,600. So anytime the stock price exceeds the $50 conversion price, the value of the bond is going to exceed the $1,000 par value. Because the straight value is going to be calculated to be $867, the bond in a stable environment never sell less than this amount, regardless of how its conversion value is. If the market price were to be $30, the bond would still sell for $867, not $600, because the bond itself has value, and since it's greater than the stock with conversion value, it'll just trade at the bond value. So that's one of the reasons that make these convertibles are a little better, is because that you can convert the value to bond or stock, which is ever higher. And so in this case, if the stock was $30, the bond value would be higher. That would be the value of the instrument. Now, the market value of a conversion is likely to be greater than the straight value or its conversion value. So the amount by which the market value exceeds the straight or conversion value of the convertible security is called the market premium. So whenever the bond is trading above its par, and the par is usually $1,000, whenever the bond is above $1,000 par, we'll say that the security has a market premium to it. So if we're to graph the market premium, we have a point at which the stock price will equal the market value. Anytime the stock price is going to move higher, it will create this market premium for the bond. So we have the straight bond value. Anytime the value of the convertible bond is above the straight bond value or the conversion value, we're going to get this market premium. Okay, so let's talk about stock purchase warrant. So a warrant is an instrument that gives the holder the right to purchase a certain number of shares of stock for a specific period of time at a specific price. So a warrant is similar to an option, which we'll talk about later. So a warrant warrants are often attached to debt instruments as a sweetener. So we'll have a bond, we'll attach some warrants that are usually detachable, and it'll give you the right to buy stock at a certain price for a certain period of time. So when a new company is raising initial capital, suppliers of debt will require warrants to permit them to share whatever success the company achieves in. So it's a way of sharing, sort of like stock options for a bond. So established companies sometimes may offer warrants too, with that to compensate for the risk and help to lower the interest rates, and have fewer restrictive covenants in the bonds. Now, with a warrant, there'll be an exercise price or an option price, and this is a price at which the holder of the warrant can purchase a specific number of shares of stock. So the price is usually set at 10 to 20% above the market price, meaning that the warrants aren't what we'd say in the money, because they're set the price which you could buy the stocks is higher than the current stock price. So until the market price exceeds the exercise price of warrants, no one will exercise the warrants because they'll be at a loss. So the purchase price of stock is hopefully looked at as undervalued. Eventually will gain more value, especially if it's like a 10-year bond. You'll have some point where the stock price is higher. The warrants will become valuable. Now, let's take some comparisons of warrants to rights and convertibles. Both result in creating a new stock, a new equity capital. Although warrant provides for deferred equity financing, the life of the right is typically not more than a few months. So the warrant is generally exercisable for a period of years. The rights are issued at a subscription price below the prevailing stock market price of the stock, and warrants generally issued at an exercise price 10 to 20% above the stock market. So there are differences between rights and warrants. Now, let's look at let's compare warrants to rights to convertibles. So the exercise of a warrant shifts from the capital structure to less highly leveraged position because the new common stock is issued without any change in debt. If a convertible bond is converted, the reduction in leverage would be even more pronounced because the common stock would be issued in exchange for reduction of debt. And that's generally a good thing. In addition, the exercise of a warrant provides an influx of new capital. So when the warrant is exercised and the stock is purchased, you're buying new shares from the company, they get new capital. With convertibles, the new capital is raised when the securities are originally issued rather than when they are converted. So the influx of new capital resulting from the exercise of the warrant does not occur until the firm achieves a certain degree of success that is reflected in the stock price. So in this case, the firm conveniently obtains needed funds. So that's what's nice about the warrants is that they're going to create new stock when they're exercised, and that will generate additional capital for the company. But the convertible bonds don't necessarily do that. So the implied price of a warrant is the price effectively paid for each warrant attached to a bond. So the price of the bond with warrants attached minus the straight value of the bond gives you the implied value of the warrants. So again, if we go to that bond we were talking about before, and we calculate the straight value of the bond, we can get an idea on how much the warrant is worth. So let's look at this product. So this marine company issued a 10.5% coupon interest rate, $1,000 bond, that's 20-year bond, paying annual interest, having 20 warrants attached for the purchase of the firm stock. The bond initially sold for $1,000 at par. When issued, similar straight bonds were selling at a yield of 12% interest rate. The straight bond value of the bond would be present value discounted at 12% current going rate. So if we discount it, we get the straight value of this bond. Since the coupon's only 10.5%, which is below 12%, we'd expect the value of it to be below 1,000. So this is the value without any warrants. So then the value of the warrant is going to be the $1,000 minus the straight value of the bond, gives us the purchase price of the warrants are $112. Now, dividing the implied price of the warrants by the number of warrants, which are 20, we get the warrant value of $5.60 per share. So thereby purchasing this product, you get a warrant, you get a bond for $1,000, which is effectively paying $5.6 for each warrant. And some warrants can actually be stripped off and sold separately and stripped from the bond and sold as a separate thing. So you could thereby actually at some point keep the bond and then exercise the warrants. Now let's look at the warrant premium. So this is the difference between the market value and the theoretical value of the warrant. So the theoretical value of a stock purchase warrant is the amount one would expect the warrant to sell for in the marketplace. The following equation gives us the value of the warrant. So TVW, the theoretical value of the warrant, equals the current market price of a share of common stock minus the exercise price of the warrant times the number of common stock obtained with one warrant. So this is the basic formula. So if we try to put this formula, let's look at Dustin Electronics. A major producer of transistors has outstanding warrants that are exercisable at $40 per share and entitle holders to purchase three shares of common stock. The warrant initially attached to a bond. To sweeten the bond, the common stock of the firm is currently selling for $45 a share. So P to 0 would be 45, E would be 40, which is exercise, and N would be 3, which is the number of shares. So the value of the bond, theoretically, would be 30 minus 45 times 3, or $15, would be the value of the warrants. So here we could see we have, anytime we have the theoretical value calculated by that formula, anytime the market value is higher than the theoretical value, we have a warrant premium. Let's look in a personal example. Stan buyer has $2,430, which he is interested in investing in Dustin Electronics. The firm stock is currently selling for $45 per share, but its warrants are selling at $18 per warrant. Each warrant entitles the holder to purchase 3 shares of stock at $40 per share. Because the stock is at $45 per share, the theoretical value of the warrant is $15, using those same inputs from before. Okay, so the warrant premium results from positive investor expectations on the leveraged opportunity. So Stan would expect to spend his $2,430 in either of two ways. One, he could purchase 54 shares of common stock at $45 per share, or 135 warrants at $18 per warrant, ignoring the brokerage fees, of course. A purchaser of the stock and its price raises the $48, he'd gain $162, $3 per share times 54 by selling his stock. Instead, if he purchases the $135 warrant, the stock price goes up $3 per share. He'll gain an estimated $1,215 because the price of a stock rises by 3, and each warrant can be expected to raise $9, and he was able to buy 135 warrants, again, 2430 divided by 18, a total gain of $12,015. So the warrants do help leverage your position. But the reason for that is there's a time limit on these warrants. So that's why they're much cheaper. So you have to hope that the stock price gains in time to take advantage of that warrant. Okay, so let's talk about options. An option is an instrument that derives its value from another underlying asset. And it's an opportunity to purchase or sell a specific asset at a stated price for a stated expiration date. So the basic forms of options are rights, warrants, calls, and puts. So those are the basic forms. A call option gives you the right to purchase a number of shares, typically groups of 100, on or before a stated date at a stated price. The strike price is the price at which you can buy the stock at. So the option will have a strike price that is usually different than the stock price, and the strike price is what you could strike the option at and buy the stock at that price. So a call option is most valuable when the strike price is below the market price, meaning you could buy it for less than it's currently selling at, and then you can turn around and sell it and make some money. So it gives you the right, hold the right to buy the stock at a bargain price. When the strike price of a call option is less than the market price, the option is said to be in the money. Now, a put option gives you the right to sell stock at a specific future date at a specific price. So it's like a short sell. So a put option is in the money when the market price of the underlying stock is below the strike price. It's the reciprocal of a call option. Now, 2 ways of making option transactions. The first involves a transaction through one of 20 or so call and put option dealers with the help of a stockbroker. The other more popular mechanism is the organized option exchanges. So you get the CBOE, Chicago Board of Options Exchange, which was established in 1973. You also have the International Securities Exchange, and you have the American Stock Exchange and the Philadelphia Stock Exchange, with all exchanges options. So the options traded on these exchanges are standardized, and thus the considered registered securities, and they're very liquid. You can trade them easily, buy and sell them easily in these markets. So when so let's just look at this matter of fact. Recession cools option trading. So like most other companies, the Chicago Board of Option Exchange saw a decline in its business in 2009 due to the recession. So the CBOE reported total options volume that year of only 1.1 billion option contracts, down from 1.19 billion in 2008. So the decline came in the area of exchange traded funds, which are like mutual funds, but they trade like stocks. So the ETF option tradings fell in 2009 to 277 million contracts, down 16% from the prior year. And it did immediately rebound until we came out of the recession, and declined a bit further in 2010 to 276 million contracts, and then rebounded in 2011 and to 201, and the volume exceeded 368 million and 311 million contracts respectively. So this is probably 2011 and 2012. It's a mistake in the slide. Okay, so option trading. So the most common motivation for purchasing call options is the expectation that the stock price is going to go up. So if you know the stock price is going to go up, you can buy options to take advantage of this increase. And since options are leveraged, you can get more of an investment for your money, and that would give you a profit. Put options, you'd purchase put options if you expect stock prices to go down. So if you expect there to be a big correction in the market, you'd want to be buying put options. As a personal example, assume that Cindy Peters pays $250 for a 3-month call option on Wing Enterprises at a strike price of $50. This means by paying $250, Cindy is guaranteed that she can purchase 100 shares of Wing at $50 per share anytime during the next 3 months. So if the stock price, let me just move this down a little bit. If the stock price moves above 50, Cindy could exercise her options, buy the stock at 50, and sell at the higher price. If the stock climbs $2.50 above per share, then she can divide the $250 by 100 shares, and to $52.50 per share to cover the cost of the option, ignoring any brokerage fees. So if the stock price rises more than that, Cindy earns the net profits by buying and exercising the option. So, yeah. Now, here's one for a put. So if Don Kelly pays $325 to buy a 6-month put option at a strike price of 40, so and the stock price drops below 40, he can exercise 100 shares of stock at prevailing stock price and his options to sell them at 40. So the stock price drops by $3.25 to $37.75 per share to cover the cost of the option, ignoring any fees. He'll break even. If stock price drops any more than that, he can make a profit from the short position. Okay, so let's look at the role of call and put options in fundraising. So although calls and put options are extremely popular investment vehicles, they play no direct role in fundraising. So they don't actually raise any money for a company. Companies aren't going to get any money from calls and puts. So these options are instead issued by investors and option exchanges, not businesses. So businesses can issue stock, but businesses don't issue options. Those are exchanges and individuals that create the actual options. So they are not a source of financing for a company because the firm doesn't actually receive any proceeds when investors buy or sell options, or when they exercise the rights to these options. Companies don't get any funds for this. Okay. So here's the focus on ethics. So options backdating. So typically employee stock options. So employees are given options as a motivator with a strike price below the current market price, hoping to motivate them to work harder for the company to become something, so they could make these these options be in the money as the stock price moves up. So one way a firm can make their stock option grants even more valuable to employees is a practice known as backdating, where they establish an option grant date at a time when the stock price is at its lowest point. So backdating isn't necessarily legal, but there are issues related to the full disclosure to taxpayers and stockholders, and failure to pay extra tax on these instruments. Earning statements and things like that have to reflect these grants. So if a firm wanted stock options with strike prices below the current market value, how could they do so? They'd have to backdate them. Why do you think instead some firms choose to backdate these options, making it appear as though the options have been granted where the strike prices were equal or below or above the stock market price? In fact, the options were in the money all along. Well, they want to because they want to guarantee profits to the managers right away. And there's a big case involving Steve Jobs where he had a number of backdated options that he was investigated for, and nothing really came of it. But it's a common practice, although not illegal. It is some ethically questionable to do this because it's really, in some ways, stealing from current shareholders. Okay, the options. Hedging foreign currency exposure with options. So options do allow companies to hedge, which you can offset or protect your risks by adverse price movements while simultaneously preserving the profits from favorable price movements. So an option gives you the options. You can choose to use the option to buy an underlying asset, or you can choose not to. So using options to hedge risk is similar to purchasing insurance. So the firm pays a premium, the cost of the option, to buy the option, and then if an event does occur that increases or lowers the price of an asset, if the change in the price of the asset is detrimental to the company, then they can exercise the option and get the profit on the option over to offset the losses in the real world. So if the foreign currency moves in a direction that's not good for the company, their hedged option contracts can be exercised to get some of those losses back. Usually not 100%, but enough of them. And if the currency moves in their favor, they just let the options expire and they just lose the cost of the option insurance. So companies can hedge themselves with options. Mostly they hedge themselves with future contracts. So let's just explain how this works. Assume a U.S. exporter just booked a sale denominated in Swiss francs with a payment due and delivery in 3 months. The exporter is exposed to currency risk because it received francs in payment, and it will sell those francs in exchange for dollars. At the exchange rate at which the transaction will occur is unknown, since it's in the future. So if the Swiss franc declines in value, then the dollar value of the payment that the exporter will receive in 3 months is reduced, because each franc buys fewer dollars on the foreign exchange market. So the company could hedge the risk of this depreciation in the franc by purchasing a Swiss franc put option. So the put option will give you profits if the price falls. So it gives the company the right to sell Swiss francs at a fixed price, say exchange rate of 104. So the option will become valuable if the value of the Swiss franc was less than $1.04 and the payments of the Swiss francs arrive in 3 months. So on the other hand, if the Swiss franc was worth more than $1.04, the exporter receives the payment, the firm would allow the put option to expire unexercised and would instead convert the Swiss franc received in payments into the dollar at the new higher dollar price. So the exporter would be protected from the adverse price risk, but still would be able to profit favorably, but not. It would have to give back some of those profits due to the cost of the hedge. Okay, so that concludes Chapter 17, where we talked about the difference between hybrid and derivative securities and their roles in the corporation. We looked at types of leases, lease arrangements, lease versus purchase decision, the effects of leasing on future financing, and we talked extensively about the advantages and disadvantages of leasing. We looked at describing convertible securities, their general features, financing with convertibles. We demonstrated the procedures for determining a straight bond value, the conversion stock price, and the market value of a convertible bond. We looked at the key characteristics of stock price warrants, stock purchase warrants, the implied value price of attached warrants, and the values of warrants. We defined what options are, discussed puts and calls, options markets, options trading, the role of calls and puts in hedging, and fundraising within companies. Okay, so that is the end of Chapter 17. Thank you for your time, and I'll see you soon in Chapter 18.